Hello, everyone. Today I'd like to briefly discuss installment agreement payment plans. These are options that the IRS offers individuals to pay their tax debt. If you're one of those individuals that has tax debt, whether it's current or past due, one of the payment plan options that I am going to discuss will probably work for you. Now, even though my memory is quite good, in order to not confuse the facts, I will refer to my notes occasionally when I'm speaking about a particular installment agreement payment plan. Again, I want to make sure that I give you the correct information as it relates to the particular payment plan. The IRS offers four different types of installment agreement payment plans. One is the guaranteed installment agreement payment plan. The second is the streamlined installment agreement plan. The third is the partial payment installment agreement payment plan. And then the fourth is the non-streamlined installment agreement payment plan. Each of these payment plans has slightly different requirement rules. So I'm going to briefly discuss some of those requirements for these particular plans so that you can have an idea as to which one may work best for you. Let's start off with the guaranteed installment agreement payment plan. This tends to be the simplest installment agreement payment plan to get set up on. This particular plan is geared toward individuals who owe $10,000 or less, who are not currently in bankruptcy, and who is not under a current installment agreement payment plan. So if you owe $10,000 or less, you may want to look into requesting to be put on a guaranteed installment agreement payment plan. The second payment plan that I mentioned was the streamlined installment agreement payment plan. This one seems to be the most common. It's for individuals who owe $50,000 or less and who agree that they can pay off the tax debt in 6 years or less. The plan slightly changed for tax year 2011. Prior to 2011, the requirements were if you owed $25,000 or less and you could pay it off in 5 years. But due to the IRS's quote unquote fresh start program, they've changed the rules a little bit. So again, currently for streamlined, it's now if you owe $50,000 or less and you have 6 years to pay off the tax debt. The next installment agreement payment plan is the partial payment installment agreement plan, PPIA. This particular installment agreement plan allows individuals who can't afford or who do not qualify for any of the other installment agreement payment plans to pay off part of their tax debt. And how this installment agreement payment plan works is that the IRS takes into consideration your financial, your income and your expenses, and what you can afford after that is what they will require you to pay until either the statute of limitations runs out or until the tax bill is paid. Now, the final installment agreement plan, the fourth installment agreement plan, is the non-streamlined agreement payment plan. This particular payment plan is geared toward individuals who owe $25,000 or more and who need more than the 5 year period to pay off the tax debt. For the non-streamlined agreement payment plan, you will have to submit a Form 433F, which is a verification of your financial assets, income, and expenses. Also, with this type of payment plan, a lien more than likely still will be issued because, if I'm not mistaken, um, anything over $5,000 qualifies for a lien to be filed against you. So, with these four particular payment plans, you will be required to either have the IRS direct debit the money from your account, or they can do a payroll withdrawal. There are several options that you have, but the IRS prefers to do a direct debit. Why? Probably because they want your bank account information. But I'm not exactly sure as to what their reasoning is for preferring direct debit. It's probably simply easier for them. With these payment plan options, you do have to make sure that you are current on your tax filings and that you do not default on these payment plans once you enter into them. Because once you default, then it's going to be required of you to make the full payment of your tax due. So if you do decide to enter into one of these payment plans, do make sure that you are able to afford the payments that you agree to. Also, if you set it up whereas it's a direct debit and the IRS attempts to debit your account twice and it's rejected or returned NSF, this will constitute an automatic default of the payment plan. And again, you then will be required to make the full payment of whatever it is that you owe. With the direct debit, you can select the day of the month that you want the payment to be debited out of your bank account. So if you do select a certain day, again, you want to make sure that the funds will be there so that when the IRS goes to debit the funds, it will not be returned, rejected, or NSF. Now, there are other options that the IRS offers to uh, reduce your tax debt or pay it down, but that will be addressed under separate cover, so to speak. I just wanted to give you the information regarding installment agreement plans so that you know that you do have options and you don't have to, quote unquote, be in hiding, if you will, or try to ignore the fact that the tax debt is there because it's not going anywhere. And again, penalties and interest will continue to accrue on any unpaid balance that you have with the IRS. So, if you want more information in regards to installment agreement payment plans, you can visit www.irs.gov. That is www.irs.gov. That's the Internal Revenue's website. Or you can visit my website at www.audiotaxhelp.com. That's www.audiotaxhelp.com. AUDIOTAXHELP.com. And you can give us a call if you have questions or if you're interested in um, finding out what you can do in regards to your tax debt. Thank you so much for listening, and I do hope that the information provided will help to make your life a little less